Hi, good evening, everyone. Thank you for joining in the call. So this is our quarterly market outlook, and Vinay could not make it for this call. He had some personal exigency. So we have Hardik, our fund manager, taking this call on the equity side, and we have Paijat, head of our fixed income, talking about the fixed income. I will be the moderator for the session, and you can post your questions on the Q&A link. We'll be taking them post the call. So without much ado, Hardik, over to you for the equity commentary.
Yes, thank you, Saurabh. And I'll again thank everyone for joining us and hearing us out for our quarterly market outlook that we have recently prepared. I will go through some of the slides that will be pertaining to the equity section and to our overall market view. And then I'll hand over again back to Saurabh. So I'll just share a few slides to basically take through the commentary that we have for this particular period. Just give me one sec while I share the slides. Yeah, so I have tried to basically create a more concise number of slides so that we can just touch upon the crux of the matter. So first of all, the first point to make is that with the IMF projections, which we have been tracking ever since we've been making this quarterly market outlook, an interesting scenario has emerged in this particular outlook. And what that scenario is that, first of all, we have seen that IMF has now projected what the growth rate would look like once the whole pandemic situation has normalized. And they are sort of expecting a normal growth going forward after the financial year or calendar year 2021 is over. So that growth is now supposed to be more normal, and there is no big pent-up demand sort of being projected by the IMF for us or for any other country. So whatever we see now is sort of the normal growth rate that we will be witnessing everywhere. And in this slide, what we have been highlighted, and another big point to take away, is that India will be one of the fastest growing economies in the coming future. At least the 191 countries for which IMF provides a projection, India is supposed to be the 10th fastest growing economy over the next 5 years. What I think this has a very big significance that maybe we should just spend a minute on. And I would take this opportunity to maybe explain a very good point that Mr. Warren Buffett gave in his 1997 Berkshire Hathaway AGM. And the question was asked about what is the success for him, one of the biggest factors for him to be successful as an investor, what has worked for him. And I think he spoke about something which was similar to the concept of a genetic lottery. He said that he was born at the right place at the right time to take benefit of the American opportunity as it existed in 1940s, just after the World War was over, the Second World War. And I think to that extent, an average Indian also has that benefit that has played out to them, who is today participating in the Indian equity market story. We are part of an economy which is going to witness one of the fastest growth rate. And that too, not one of a small economy. We are one of the largest countries in the world by population. We are the largest. And apart from that, the economy also is of a sizable nature and playing a very important role in various industries across the globe. So from that perspective, it is a very good time for investors to continue to participate in the Indian equity story. We've already seen a very strong return in the history, but that is expected to continue. And IMF's GDP growth projection for India kind of echo the same point that has happened for the last so many years for someone like an average American. So that's one point that I wanted to make from this slide. But the other thing, if we were to try to look at the current aspect of the economy, the current situation that we are looking at, while the long-term story is good, we also have to try to keep in mind the current situation while trying to decide where the asset allocation has to be if we have to participate immediately. And to that extent, with the IMF projections also indicate that the impact that the pandemic created on the economies are expected to last. So the world is expected to have lost about 4% of the GDP over the course of this pandemic. And the Indian economy is expected to have lost about 11% of its GDP over the course of this pandemic. So that's just a point to keep in mind, that the pandemic was not really a event which has seen a complete recovery. While the economies have picked up very sharply, people were expecting a very big decline. As we can see, as high as 6% on the world GDP and 14% for India was expected to be a big decline. The recession probably was expected to last longer. So the good thing over here is that we have seen a very sharp recovery. most of the important parameters in our country were running very efficiently. After a few waves of the pandemic, we saw a very strong pickup in many economic activities. And we are currently seeing that there is a V-shaped recovery for most things. As we are looking at the financial numbers right now coming up for India incorporation, we are seeing a very strong growth rates coming out everywhere. So yes, we have seen a very V-shaped recovery. Different natures of alphabets have been given to ascribe or define this recovery. I'm sure more genius ideas will come, but the crux is that the impact was supposed, or rather first feared, to be much lasting longer, but it's not. It has seen a very sharp recovery, and more importantly, all different sectors have shown growth. The only part that is lagging still in the India's economic growth story is the private consumption so far. So that is one area that we are closely monitoring. Most companies who have given their outlook for this financial year, or the performance that has gone for the few quarters gone by, indicated that the consumption, especially in the rural parts of the economy, have been lagging. Urban consumption has picked up, and the commentary has been soft on that part. So that's one important driver that has to pick up. And once that does, then the economy will be in its full swing, which is expected somewhere in financial year 23 going onwards. But I think the most important part which has led to this kind of recovery and led to this very strong growth is the way the government has maneuvered through different legislations and basically made so many reforms, which have actually made the economy a much better growth engine. And there have been quite a few, not only announced during the pandemic and around the pandemic, but even before that. The big tax rate cut was a very big game changer, which was announced in September 2019. Apart from that, there are so many other measures that have been announced by the government, which will make India definitely a very important growth engine and help it realize the growth opportunity that lies ahead of it. The PLI, of course, has been a very important event that took place. As time has progressed, PLIs have been announced across 14 sectors, and new sectors are constantly being talked about to become a part of this PLI initiative that the government has started. This amount already is 1% of a nominal GDP. So a sizable amount will be paid out as incentives to companies or production units that incrementally manufacture products in certain sectors that have been specifically highlighted by the government. So this is a very big key role. And from that perspective, I think that's another point to be taken into, because we are also looking at the whole Indian economy growing in that way and focusing on some of these sectors. One final point to make is the fair value update. So we have been using this forum as an opportunity to communicate with you where do we feel the markets are in terms of its valuation. And compared to our earlier commentary, what we would say that while the markets continue to trade at a premium, Nifty is still at a premium to its fair value, the extent of its premium has definitely come down. It is driven by two factors. One factor is, of course, the correction, which is both the time correction as well as the absolute correction that we've seen very recently. Nifty is at the same level it was in, let's say, 31st of August 2021. So in the last 5 months, Nifty has probably given flat return. So there's a time correction that has taken place and an absolute correction that we've seen in the last few months. And more importantly, the fair value of our country or Nifty is a growing concept. We are a fast growing economy, as we already discussed. And hence the companies that are participating in this economic growth are also seeing their fair values grow at a good pace. So the red line is also growing upwards, while the blue line has moderated, which is the price of Nifty. And today the premium has come off. It is still in the high single digit premium range. So it hovers around 9 to 8% in that range, but it has been still very robust. So we are continuing to say that markets will be at a premium, but yes, we are getting more and more in the reasonable zone as time is progressing. So that's the broad point. Now, in terms of what we are recommending or how are we seeing, if we summarize our view, the increase in the interest rates in the medium term is definitely a concern for valuations, as we've been highlighting, and we have seen that there has been an unwinding of these policies globally. So Bank of England was the first one to start with 2 rate hikes. They have done already. The US Fed has also pointed to what they will be doing in the coming few years on as far as interest rates are concerned. So generally, the policies on monetary situation in most countries is seeing an unwind and a hawkish view being formed. That definitely will have an impact on valuation, as we see. Apart from that, we are seeing that there will be an inflationary concern. So we are seeing margins in the short term being impacted, and valuations hence are not very attractive at this level. What is working for Indian investors at this point of time is that we are going to see a start of a capex cycle. Our economy is recovering very well. And a lot of measures that have been announced by the government is going to support even a stronger growth going forward that many agencies, third-party agencies are assuming going forward. So having said all this, we are currently preferring large caps over mid and small caps. We still feel that even when it comes to relative valuation, large caps are relatively better placed. While there is a general premium in the market, the return potentials have relatively gone better than what they were, let's say, a few months ago, at least 6 months ago. So we will be seeing stronger potential from that perspective. As far as sectors are concerned, we have changed our sectoral stance. We have been overweight IT for a long period of time, and that stance has changed. Given the valuations and given the way the sector was starting to see certain, not really moderation, but the upgrades that were being seen earlier were not happening, and the valuations had already captured a large part of the upside. So our fair value models indicated that currently this sector is providing relatively lower upside than what it has given for the last 20 months that we have been overweight on it. So that position has been changed. We have made room instead for financials as a sector, which is now something that we are more overweight on, because as the economy progresses and recovers and continues to grow faster from here, banks will play and the financial institutions will play an important role in driving that growth. So we have gone overweight on the financial space. Apart from that, telecom and consumer discretionary are some areas that we also prefer, which we have been looking at attractively for some time. Areas that we are underweight apart from IT has been materials and utilities, where we feel that valuations or the business model are still not attractive enough for us to take a very constructive sort of a call. Another space that we, by the way, continue to like is infrastructure. So government, of course, through its budget has indicated that that is one area that they will not slow down on and continue to spend on. And hence we are looking at companies and sectors which are going to drive this growth for the government in terms of infrastructure development going forward. In terms of recommendation, yes, asset allocation recommended products are currently our recommendation. We are suggesting that given that if you have to participate immediately today, there is still a premium in the market. So participating through asset allocation products might make sense. But having said that, equity valuations are now at a level which is better than what they were, let's say, 6 months or 1 year ago. And given the time correction, there would be a time where equity markets would end up becoming relatively attractive if this kind of time correction continues. And having said that, even if we look at any equity product from our perspective, while we have had a conservative stance on the overall market, our equity portfolios are well positioned to participate in this strong growth story that India Incorporation offers. And we have not taken any cash calls, neither have we shied away from basically holding strong growth potential businesses. So from that perspective, our equity portfolios will continue to drive a benefit from the growth that the economy will see. So that's the broad outlook from my side, Saurabh. I will hand over the call back to you.
Thank you, Adik. Paijat, can you put the video on, please? What do you, Paijat, for fixed income?
Yeah, I'll just share this slide.
Yeah. Adik, can you stop sharing the slide? Thanks.
Is it visible now?
Yes, it is. You can put it on the slideshow mode.
Yeah, I'm doing that. Yeah. Okay, so on the fixed income side, we have seen the roller coaster on the bond yields. It has been an extremely volatile period for the last, I would say, 2.5 months. And globally, the inflation has taken a center stage. And what we have seen is that the inflation is running red hot in the developed economies, and where we have noticed the last data point at 7.5% in the US. So similarly, that we have seen that extremely high and persistent inflation data in Eurozone and UK also. So obviously, the view emerging now that initially it was because of supply constraints, but now the inflation is getting entrenched. So that's why we have seen comments coming out from the developed central banks that the time is right now to start moving towards tighter monetary policy, move towards rate hikes, and reducing the balance sheet size of the central banks. So that's what's the view is emerging, and obviously looking at that, the rates globally has moved up. And if you look at our own domestic market, we had the RBA policy on this, which was announced on 10th of this month, about a week back. So here what we have noticed is that though the market participants were believing that RBI would also take that stance, continue with tightening liquidity, raise the reverse repo rate, narrow the corridor of between repo and reverse repo. However, what we noticed that RBI's policy was very dovish. In fact, it is I would say a very welcome change that we have somehow, we can say that we have not followed the path what the developed economies are following, but we have taken our own data points, the domestic data points, to shape of our monetary policy. Now, whether that is correct or not, that's only the incoming data can tell us. The first and foremost was that the RBI's projection on the inflation, which came at 6% for the last month, has projected that for the full year, next financial year, it would be 4.5%. That's a very substantial dovish outlook on inflation. So because they believe that the inflation is not going to run away, just like it is happening in developed economies, we believe that RBI would be very, very slow and gradual in policy normalization. So that's one key point which has come out very, very clearly from the monetary policy. The other factor is that the looking at the benign outlook on inflation, RBI is expected to keep the financing conditions very easy. So we believe that the liquidity in the domestic system would remain abundant. If you look at this chart, this is we do it in-house. What we call is a high frequency leading indicator. We use 29 parameters, and these are again bucketed into 4 buckets. That is like ease of living, consumption, investments, and external sector. If you look at this chart, the pre-COVID HFLI level was somewhere around the 29 percentile, and it is still not reached. So one factor which forced or RBI and MPC looked at was that we have not even reached the pre-COVID HFLI levels, and the growth still needs policy support. So that would be one reason that RBI kept the policy rates unchanged and continued with accommodative stance. And we believe that the policy normalization would remain slow and gradual. Now, this is the macroeconomic state snapshot. The consumer sentiment remains weak. So, still at the same levels what it was in September. So we have not seen any jump there. Employment rate continues to be the same. These are 60 monthly data, CMI data points. Credit growth, though it has picked up, but as of December, but what we have noticed is that it has started to stall and coming down again. So generally a quarter, we see some uptick. So same thing would be visible in March, but overall it is still not reached the, I would say, the pre-pandemic levels. Capacity utilization, this is one thing which we believe is that the main factor why the MPC is supporting growth through the monetary policy. We are at a very low rate at 60%. Normally, when we reach somewhere around 85%, then it is said that economy is fully running ahead. So we are long away from there. So that's also one factor which may have tilted RBI towards easy monetary policy. Now, if you see the key policy rates, a 2-year yield, we have seen that before the monetary policy, what we had seen that when the budget was announced, in the budget, the government announced a very heavy borrowing for the next financial year. with a fiscal consolidation of 6.4%, and for this year at 6.9%. So, and the gross borrowing for the next financial year at 14.95 lakh crores, which because of some switches, it comes to 14.3 lakh crores. Obviously, this is a very, very high borrowing numbers because the domestic buyers are your banks, mutual funds, insurance companies. So these are the large buyers. And in absence of any big buyer, markets were anticipating that we will have, the some announcement on global bond indices, inclusion in that. Some, light would be thrown on how the taxation issues would be dealt with. But anyway, the budget was, very silent on that. And we saw a very violent reaction on the first itself. After that, in that week, we saw that bond yields moving up by almost 30 basis points. So the 10-year was around 6.65. It moved up to 6.95. However, after the RBI announced this policy, the views became very clear. The bonds will retraced back to 665. So as I speak to you, it is at 6.66 today. So, a main factor I would like to highlight here is that the supply issue is a major factor in terms of some part of the yields. So what we had seen, a violent reaction happening by 30 basis points and similarly coming down because of the supply issues. The moment they realized that, RBI is there to support, we saw that yields coming down. And in fact, the 6.9%, the deficit, which was announced in the budget for this financial year, revised estimate, is expected to be lower than 6.8. Looking at, RBI has already cancelled, last two auctions, and before that they had already cancelled, some 30,000 crores. So in a net, somewhere around 75,000 crores of, auctions have been cancelled, and there will be no more, bond switches. So these are comforting the bond markets a lot, and we have seen the bond yields remaining at 666, back to where they were before the the RBA policy, before the budget announcement. The only factor which can lead as of now some extreme reactions is when the Fed meets on 15th of March and announces a very, very hawkish statement about the rate hikes and running of the balance sheet. But to highlight here also, it is very important to understand that when you try to tighten very quickly, it starts impacting the growth also in a longer period of time. So one can see inflation. So if you look today, the US yield curve is actually pricing a neutral rate of somewhere around 2.25. What it means is that even if it reaches at this level, 2.25, that is the policy rate, that is a point where the economy will just chug along. It will neither be slow nor fast. So that's what is called a neutral rate. So that's what the market is building. And if you see the curve, the entire US curve, it is building some kind of a recession going forward because the 7-year and 10-year has become flat. So a flattish curve means that, or an inverted curve which starts building in, it starts showing that there could be some kind of recession if the Fed starts hiking, very fast, or they start hiking as well as start selling the assets which is on their balance sheet. So that's how the markets will take it once it is announced, and then further course would be determined. Now, as I highlighted, rates are trending upwards across the curve because supply side pressure, as I mentioned, fiscal slippage, which I mentioned just now. But anyway, RBI has already cancelled, so it is expected that it would be lower than the revised estimate. The biggest threat to all our calculations is obviously the oil prices running ahead of $90 a barrel, 90 to 95, it's hovering around. So that's a big concern because that is like an imported inflation because we import a large part of oil consumption. So that's going to be a key factor to monitor. The input cost, including freight, remain worrisome. That's still there. And market volatility, because it spreads across the globe because of any geopolitical uncertainty. What we see in the Russia, Ukraine, or anywhere else would impact the rates. Global spillover would remain, as I mentioned. The Fed, if starts tightening or hiking very fast, that would have global the domestic impact. We could see rupee getting under pressure. So as of now, we expect rates to be under upward pressure. But the speed at which it would go up would depend on a lot of factors, which I just highlighted. So in such a scenario, it is prudent to be cautious in terms of the rates direction, though it has an upward bias. So that's all on the rate outlook as of now. It would depend largely on incoming data, and it would get I would say rebalance with the incoming data, how the data pans out. So that's how it is. I'll hand it over to Saurabh.
Thank you, Parijat. We'll move towards the Q&A session. Hazik, there are a few questions on equity which I'll be asking you. Mr. Kamlesh Dixit from Ahmedabad has got a couple of questions. The first question is on our IT sector position. So he wants to know whether are we moved completely out of IT or we have gone underweight, and also the reason for the view. This question is basically, as you discuss on changes in weightage of IT sector in the portfolio, can we give more clarity? Are we going underweight or we are going away from IT? And are we also not seeing IT, especially India-based IT companies, still attractive for mid to long term?
Yes, so we have gone underweight. Yes, and it is one of our large underweight positions because on a relative basis, the call is more to do with valuations. See, what has happened over the last 18 to 24 months in the IT space is that a sector which was typically considered a sector which would typically trade at a P multiple of 2024, as our fair value methods indicated that the valuation should be much higher. See, a few years ago, the average multiples given to even the large cap IT space would be in the region of 18-17%. These companies were trading at as high as 40%, 40 times also on a 1 year forward basis. Our models were justifying a big increase because, as you know, we use a fair value model which tries to capture these long-term, medium-term opportunities in the space. And to that extent, the high valuations were justified. But what had happened in the last 3 to 4 months, there were two bigger events that took place. Of course, the interest rates being a bigger event, because what that does is it has a higher impact on companies where the earnings multiple was high, where valuations are stretched, especially the multiples being high because of high growth opportunities. When the interest rates go up, it's the high growth companies that see a bigger contraction in valuation. And we have observed that. We have changed our interest rate forecast estimates, and accordingly, we were seeing this change happening also over a period of time. Apart from that itself, the valuation of the IT companies had crossed a certain threshold. Our models were not justifying an upside anymore, and other sectors on a relative basis started appearing more attractive. So while the growth story is attractive going forward, there are certain companies that we continue to hold because we believe in that. But on the whole, there were many mid-cap, small-cap, and certain large-cap names where too much valuations were being given for this growth, and that correction has happened. And if you see the last result season that went by, we saw that also playing out, right? When even the companies were reporting one of the best growth rates in the industry at 6 or 7% quarter-on-quarter growth rate in the IT space in dollar terms, which is a very enviable number to grow by. We were not seeing that kind of change manifest in stock prices. It was very clear because the valuations were already at a brim, and there was an expectation that the company should actually grow better than what was expected, not just what their last 2 to 3 quarter growth rate is. So since there was no big upgrade also in the fair values that we witnessed, after a long time, upgrades kind of stopped in this particular quarter. There was no meaningful upgrades in the fair value, and valuations were expensive. We have become underweight. The underweight call is primarily also, as I said, driven by valuations. So the other sectors which we have gone overweight on a relative basis appear more attractive. So banks and financials for that reason have become overweight. So it's not that we don't like IT as a space, really. It's just that given the growth rate and the valuations that we are seeing, another sector makes more sense going forward. And that is why we have changed our weightage to financials. So that's the point. On a stock selective basis, yes, we are taking the point that you just made. We are looking at certain companies which are actually growing much faster than the overall IT spending growth in the world. And companies in the ER&D space, or companies that are specifically focused on digital transformation and cloud migration. So those companies continue to be the stocks that we like, and they are our picks. They are picks within the overall sector. But on the whole, the sector was richly valued, and we had to take this switch.
Thank you, Adik. Kamlesh Dixit from Ahmedabad, a follow-up question on BAF. So the question is on the performance of BAF, where initially the feeling was that the BAF is a conservative fund, but there are certain points of time when the fall in BAF was much more than the markets, and when the markets reverted back, it was not able to like catch up in that period. So I don't know what time frame Mr. Dixit is talking about, but this is a question that he has posed.
So honestly, it will be tough. So what we have observed is in the last few periods when the market has fallen, we have seen the BAF also falling less. So our broad observation has been that this has happened. A few days of divergent observation could be due to multiple factors, which will be difficult to point out, to be honest. What we have, however, we have seen is that over the period where the market has given a negative return, our BAF portfolio has fallen lesser, is what our observation has been. But as I said, it's very difficult to call out any specific time period or few days where there might have been a different observation. On the whole, we have seen the last 15-20 days, we have seen the BAF portfolio perform in line with the expectation.
Thanks, Hardik. The next question is for Mr. Nagarajan from Hosur. He's referring to a slide on fair value chart 2021 on your presentation, what you showed. His question is, the fair value chart is showing steep up even in the current region, whereas the market has actually gone negative for the last 3 months. That means the fair value should catch up with the Nifty, but the chart shows a parallel growth of both Nifty and fair value. Please explain.
Because the premium that existed as of FY21 was 9%, and the premium that exists as of Jan 2022 is also around the same region. So that is why it appears that over these two data points, Nifty and the fair value both are appearing parallel to each other. So when we were looking at the fair values back in the, if you remember, a year ago, we had actually given out a fair value update where we specifically told all our participants that fair values are no longer attractive. This is when just the market had crossed its 14,000 odd mark in Jan, and we went out and we said that while we have been very aggressive, our BAF portfolio has been very aggressively positioned for a good part of 2020. We came out with an update saying markets are now in a premium. So the attractiveness that we saw, the low-hanging fruit that we saw in terms of return had gone away. So from that level, we are back to that level where the markets are now again at a single-digit kind of a premium. And hence, it is looking like there is a gap. So both fair value and the markets have grown at the same pace. Net over a period of time, the market movement and the fair value movement has been the same. So the premium still exists.
Okay. The next question, Mr. Sandeep Bushetti from Pune. How many rate hikes are we expecting in the next financial year in India and in US? So it's not mentioned, but you can talk about both.
See, as I mentioned, sir, it depends upon the growth trajectory. But one can say that, the rates hike, at least in the domestic market, would be shallow, because as I highlighted, our HFLI and other data points. So, before the pandemic, the repo rate used to be 5.15. So, at least for the next two policy cycles, I expect the repo rate to remain same. Maybe in the next two, we can see another 50 basis rate hike. That's what it looks as of now. This view can go under change depending upon whatever the incoming data that we have. If tomorrow, the oil goes to 125, obviously this view would change. So this is as of now.
Thanks. The next question is from Mr. Satit Sangai from Nagpur. The views on banking and metal sector.
Right. So banking sector, as I said, actually appears attractive. from the valuation perspective, there are a lot of momentum wise, there are business in the business that is, sort of momentum that is building up. You are seeing that system credit growth is picking up for the banking space. And even the loan growths within the banks and a financial space, which are not necessarily retail, are showing some pickup. So generally, we are seeing that economy overall, the banking system is seeing a pickup in loan growth. The bad asset cycle is on the recovery mode. So we have seen a consistent improvement in the NPA levels for most banks and most even NBFCs. So there is a consistent improvement being seen there. So we are at the start of a cycle where, as the economy recovers, you will see that more and more lending happening and banks going out and basically taking a good part of this, driving good part of this growth. So we feel that this will be one sector which is going to drive certain upgrades potentially going forward. The fair values are currently showing that there is a decent upside in these cases. And that is the reason why we have changed this stance. We are going to see a growth in the capex cycle, both on the government side as well as on the private side. And that definitely will be funded through loans and through debt. And to that extent, the banking sector also appears attractive. So one is on its own, it's coming through a down cycle from the pandemic. Second is the economy itself is going to do well. Both these factors makes banks and certain NBFCs very well positioned to be benefiting from the economic recovery that we'll be seeing continuously going forward. And that's the main reason why we like banks, and we have gone overweight on banks. On a relative basis, they still appear fair in terms of valuation. On the metals, this is a sector that we have been avoiding, or rather not having an overweight over the good period of time. And the reason is that there is a very heightened volatility, and currently we are at the peak of spreads, as we have witnessed. Although this quarter started seeing the profit spreads kind of contracting actually. So we have not witnessed any strong competitive advantages that have emerged in this sector. The sector typically in the past has been driven by only movement in commodity prices and certain short-term changes that open up on the demand-supply situation. So nothing structural has really played out for us from our process perspective, to take a more constructive view on the metal space. And to that extent, we are not directly playing any metal plays. Yes, we are playing certain companies that are ancillary or are going to benefit from, let's say, more production that happens in this space going forward, but nothing that directly is completely dependent on this space. So it's a space that we continue to avoid.
Thanks, Adi. There are two more sector questions on infra and auto, especially in light of the after the budget. So can you also give a quick view on
infra? Yes. So infra has been the most interesting one, to be honest. So, and I think the important point to keep in mind while looking at the infra space is that what we considered as infra a decade ago or more than a decade ago in terms of growth opportunities or the way things will pick up, that's going to be very different. There are different kinds of infrastructure support, initiatives that are being taken. Roads and railways, of course, have been a focus area for the government. But if you look at some of the new announcements made for data centers being classified as basically infrastructure sector, which means that they can get funding at better rates. The fact that other renewable energy spaces and even the higher allocation given to solar, for example, solar manufacturing, solar module manufacturing in the PLI space, all these things are indicating that the government's focus is on a specific new segment of infra development, apart from what has already happened on the roads and railways side. So we have positioned ourselves, in companies which will directly as well as indirectly benefit from the capex going forward in these new segments. We are of the opinion that while the private capex might pick up, definitely we have been hearing a lot of industry participants talking about it. The probability of government capex picking up is way higher. And some of these capex announcements that have been made in the recent past are indicative of that we are seeing road and railway capexes or announcements happening very frequently, and companies that are, as I said, directly or indirectly benefiting from these are seeing a very strong business momentum as the quarters have progressed. So even before the budget was announced, business momentum in some of these companies has been very strong. So we already were looking at infra and infra ancillary space in a very interesting way, in the sense that we were overweight on them. But over this rebalancing that we did in the month of January due to high valuations, that is one sector also which has incrementally gotten more position, more weightage across our portfolios. So that's one sector we like. But the only point I wanted to make is that the typical names that have played the infra story in the last decade or before when the infra boom happened, those might not be the same names because infrastructure, as we know, is going to be developed in a different manner. So accordingly, we have positioned ourselves, is what we believe. On the auto space, again, this is a sort of a bipartisan sort of an approach. See, on one hand, you have the normal recovery happening on the traditional auto side, right? So I see the internal combustion engine-based business models, which are going to see some sort of cyclical recovery because there has been a very weak consumer demand cycle, let's say for passenger vehicle or the two-wheeler space for quite some time. Even before the pandemic came, if you would remember, the growth in both these segments was badly affected. So on one hand, you have a good cyclical recovery happening for the overall passenger vehicle and the two-wheeler industry, and also commercial vehicles are expected to stage a comeback as the economy picks up. The question is which industries are actually going to grow, or rather which companies are going to grow over the long run, because some companies have focused more on electrification of their portfolio and drive the EV change, while some companies are still lagging on their overall EV plans. So we have tried to balance our portfolio between this. There are certain plays, again, directly or indirectly, which are positioned on the electric vehicle opportunity. We have taken a more constructive position on some of these positions. As you can see through our portfolios, we have done that. But having said that, I think there is a short-term opportunity or a medium-term opportunity that will open up as the consumer demand comes back, and some of the businesses which are on cyclical low will also benefit. But if you ask of us on the long run, we are more bullish on companies which have taken some firm steps to benefit from the electrification of the overall mobility space. So either we are playing this through some OEMs who are driving change on this, or we are playing this through certain ancillary companies who are supporting growth of EV-based companies, both in domestic as well as in export markets. So on the long run, that is what we like more. But yes, I think the overall auto space is supposed to see a big uptick, just like banks. As the economy recovers and demand sentiments come back, this space will also see a big growth.
Thanks, Adik. The next question again is a sector specific, that FMCG was always considered as a defensive sector, but inflationary concern and margin pressure has put this sector as underperformer in recent times. How do you see FMCG sector growing in coming years? And do we plan to be overweight at current levels?
So actually, FMCG has played a very good defensive role. If you remember the year of 2020, when the markets were seeing a correction, FMCG actually was playing the role that it was supposed to play, which was the businesses in the FMCG space did not show a big decline. In fact, most of these companies are showing a 10-11% growth, and still on a pre-pandemic basis, the growth is positive. Whereas you are seeing some of the other sectors like auto or others showing 50-40% growth, but that is because the pandemic was seeing a big impact. So the industry has played its defensive role as it is, because that is one of the segments apart from healthcare, which did not see too much of an impact of the pandemic. What I would only say is the last 2 years has not been a play for defensive sector. The last 2 years after the pandemic immediately was starting to recede has been a play on the growth sectors. And we have seen a growth-based momentum in the market. So from that perspective, yes, FMCG is not necessarily a very fast growing industry, and to that extent, it has underperformed. We are of the opinion that the market would continue to focus on growth-based fair values, because, as I said, India is one of the fastest growing countries in the world, one of the fastest growing. And to that extent, I think capital will be allocated towards businesses and industries which are going to report stronger than the nominal GDP growth rate. To that extent, I think FMCG are only places where allocation will go up if valuations are attractive, because growth necessarily is not one of the fastest that you can see. So that is our view going forward as well. We are not overweight on the sector as such. There are a handful of companies here and there which have demonstrated faster than GDP growth consistently and still have a strong growth potential going forward. We are positioned in those names, but on the whole, I think the valuations still are a little expensive for the growth rate that this sector offers.
Thanks, Adik. There have been a couple of questions on BAF. I'll combine them. So one of the view coming is that why are we holding BAF for so long at 30? And the BAF in short period of 1 year has been performer compared to peer group? How are you managing BAF, and are we looking to move up the allocation? So basically on BAF performance short term and the reaching for 30% allocation.
Right. So the way I would put it is, yes, the last 1 year has been a period where the BAF has shown the return that it has related to peers or related to the benchmark. But the point I'm trying to make is that of the products that we have in our kitty, BAF is the one which actually shows its best, the advantage that it has as a product. It is best seen over a longer term, and 1 year is definitely too short for appraising that performance. So what I would say is that when the markets had corrected the sharpest in, let's say, March 2020, our model was indicating a very sharp increase. As I understand, we were one of the first funds to increase allocation all the way up to 80%. And what I would say is that we have also held that position for the longest, in the category. So we had 80% allocation from the end of March towards almost the end of September. So not only was the allocation increased during this 2020 period when the market ran up or rather bottomed out, but it was also held for the longest period. So, and very, very aggressively, we increased it within a trading session of 20 days, it was increased. So we captured a large part of the low valuations that the market offered in March 2020, and we benefited from to a great extent over that period. But of course, the model, on the other side, what it has done is it immediately indicated that when the markets became at a premium, it had suggested that the allocation should fall down. So I don't think it's fair for any model actually can capture both the up move and completely protect from a down move as well very quickly. So from that perspective, we have seen a very big improvement that happened. What we have promised as to our investors for this product is that the portfolio will try to generate significantly better returns, let's say compared to, let's say fixed income possibly over the long run. That is the aim to do that with the least volatility. So compared to Nifty also, the returns have been relatively lower, but the volatility has been far lower. So the idea is to grow wealth with much lower volatility, which is something over the last 3 years it has demonstrated, or 4 years, which is the since inception period that it has demonstrated. The last 1 year has been something that is contrary to this model's overall philosophy as well as the overall make of it. So the market has gone up despite being at a premium, but has continued to climb up, and only in the last 6 months there has been a time correction. So that is the context of how the performance has been. The last one has been difficult for a model which is more valuation based like ours, but over the long run that has paid rewards, and the performance continues to be the way it is. For this product, we have to give it more than 3 years to basically appraise its performance. As to when will we increase the allocation, the way the model is structured is when the valuations are fair, the model goes up to 50%. So when there is no premium, Nifty is not trading at any premium to its fair value, the allocation goes up to 50-55%. When it becomes extremely cheap, it goes all the way up to 80%. And when it is still at a premium, it will be at 30%, which is where we are today. So if the time correction happens for, let's say, another few months or few more weeks, we will definitely cross the 30% threshold easily. That's what the model will start showing. And as the valuation levels merge, we will be up at 50%. So now how will we reach there? It will either require an absolute correction or some time correction for some time, maybe a month or two, when we start seeing allocations at that equalish range. But that's how the model is structured. As I said, there were periods over the last 3 years where the benefits were reaped, and there were periods over which the drawbacks of a valuation-based model were also observed. But over the long run, I think net the model has delivered as per our expectations, and the portfolio has given above average returns with below average volatility.
Thank you, Hadik. Just to add on to the Hadik's point on balance advantage fund, that the model is completely based on fundamental, and in the markets that are driven by fundamental, the fund will outperform the peer group. And markets where momentum is there, the category will underperform the peer group in that short period. However, if you look at the rolling return data, you compare different points in, you will realize that the fund is consistently above average. And as an investment side, our endeavor is that all our funds should be consistently above average in quartile 1 and quartile 2. On a short period of 1 year, 2 year, frankly, there's very little control that any fund manager can have on a short period of 1 year and 2 years. especially on the equity side.
Saurabh, can I add a point here?
Sure, Pradeep, hi.
Yeah, hi. It's about BAF because I see that there are probably maximum number of questions about BAF. So, the objective of BAF, as Hardik explained, is to produce decent returns with significantly lower volatility. Now, how does a BAF make money? BAF does well by losing less in, bad markets or when there is a correction, so that it has more money to grow in a good market, right? So to evaluate BAF, any BAF, not only our BAF, any BAF, you should ideally see it through at least one cycle of bull market and bear market. If you see any BAF only in a bull market or only in a bear market, it will not give you the right indication about the way it is managed. So please give it time. We have done well in the past. Our process is the same. We continue to manage it the same way. So please have faith in us that fund will do well. It will do what it is supposed to do. It will not outperform the equity market because it is not designed to outperform the equity market. It may happen at some stage, but that is, incidental. So it will give you good returns with low volatility. That is the way it is designed. Rest assured, we will ensure that it is managed like that. Don't worry about short-term underperformance. That can happen in any fund. Watch it over a period of time. You'll be happy.
Thanks, Pradeep. And I think Mr. Sandeep Bushetty has seen you on the video, and the next question is for you from Pune. When are we launching NFO? And we have not been launching NFO in the last 1 year.
Yes, that's true. It's for a reason. You see, one thing is that when we have been holding a view that market is expensive, okay, equity markets are expensive, then to come out with an NFO and ask people to invest lump sum amount in equity market, and that too within effectively on 1 day, we thought it's not fair, right? So when our own view is that market is expensive, we thought we should be fair to investors and wait for a more appropriate time. We are not trying to time the market, but when the view is very clear that market is expensive, we thought, we will not be really true to ourselves if we come up with an NFO. We have a couple of funds in the pipeline. One fund we already mentioned to you. We are working on an innovation fund, innovation and disruption, a thematic fund, which we are very excited about. We think this is a fund which has potential to create good long-term value, and it's a very sustainable theme because innovative companies are always going to be there. It is not like a narrow sector fund where it's a flavor of the month. It will run for 6 months and after that it will fizzle out. So today, if you have one set of companies as innovators and disruptors, 2 years from now, 5 years from now, it may be a different set of companies, but you will always have companies which are innovators and disruptors. So we are very excited about that. So in all probability, that will be our next fund. You can expect that in the next few months. And we are working on one more, which may happen only in the next financial year, perhaps the second quarter. As you know, we are not a sort of NFO driven fund house in that sense. So we'll do something only when we think there is some purpose behind it. Just to get assets, we think there is no point in doing an NFO. But there are at least 2 ideas that we have where we think there is room to launch new funds. So I think in the next 2 quarters you should be seeing one each.
Thanks, Pradeep. The next question is on the crude oil movement. So if the crude continues to move up, government, and the government hikes the petrol and diesel prices further, what is the impact we can see on the equity market?
Well, the first impact, of course, is going to be the inflationary impact that we will see. And the biggest, of course, cost is going to be the logistical cost that will see upward pressure. It is something that has already started to play out. So while the logistic cost in domestic front is not, has seen that impact already, the cost overall, even freight costs globally, shipping costs have gone up. So the impact we are going to see will be on the equity markets in terms of the earnings for the next few quarters or till whatever time this inflationary situation remains. But our understanding has been historically that such pressures are not long lasting. They continue for a few quarters or till the time the demand supply situation is not in favor. Right now, we know what's globally happening on the political tensions, because of which there has been an upward pressure on the crude prices. That has been one of the bigger points. And that is something that has driven this short-term phenomena. Over a period of time, we should expect crude to fall down to normal levels when situations normalize on some of these fronts. And these costs are not supposed to be, even when valuations are done in the market and when businesses are appraised, their performance on profits, if impacted by some of these short-term factors are concerned, then they are taken out. Most companies are open in basically calling out these impacts, quantifying them so that investors can better understand what was the nature of these impacts and how much to basically consider as normalized earnings. So from that, I don't personally see as such a very big impact, a sustained long-term impact having playing out on some of the valuations. There can be some short-term volatilities, which probably will be good if they happen, so that they can open up mispriced opportunities for us to buy. But I don't personally expect this to have a very long-lasting impact on the markets and valuation and the company's profits.
Thanks, Hardik. The next question is from Mr. Vishal Thakkar from Mumbai. And I'll take that. What's the time horizon that we suggest for BAF? So like Pradeep mentioned that the true beauty of a BAF comes out when you have seen both the cycles, a bull cycle and a bear cycle. Now, typically BAF should be a very stable part of the portfolio, the core part of the portfolio, which is held for long term. And the purpose of BAF is that you're holding on to a BAF because the risk profile of the investor is slightly more conservative than pure equity investor. He doesn't like that volatility. Otherwise, if you're holding it for 5 years and above, why not equity fund? The reason you are getting into BAF or you're recommending a BAF to client is that the client cannot take that volatility of the equity market. He doesn't have that risk profile. So BAF is a good alternate on that time frame. I would say minimum 5 years or even beyond for people who don't like volatility. So just to give you a simple example, if you're looking at a 5-year period and BAF is moving between 30 to 80, on an average, BAF would be at 50 in 5-year period, which means you should expect half the volatility from BAF category compared to Nifty roughly, or 60% volatility compared to Nifty. But trying to give a very similar return which are higher than traditional investment options. So in short, the answer is 5 years and beyond long-term portfolio for people who are more risk averse than a pure equity investors.
Just to supplement Saurabh's statement, I would say, yeah, ideally 5 years, but a bare minimum of 3 years. After all, it's an equity-related product. So anything less than 3 years will not be appropriate at all.
Okay, just give me a sec. Hardik, there's one more question on the sector from Mr. Sundaram from Chennai on chemical sectors. If we can quickly cover that.
Yes, so it's an interesting sector. Unfortunately, there is no large cap company to directly play on it. So it's hence when I speak of this sector, it predominantly becomes a mid cap and small cap specific sectoral play. And very interesting sector. I think the chemical sector has been in the up move and has been in the limelight for more than half a decade now. And for right reasons, the sector is basically benefiting from the reducing supply condition in China. There have been some specific events on a regulatory basis that have happened in Chinese economy, which has opened up the opportunity for Indian chemical companies. And apart from that, Indian chemical companies have been true innovators. They don't necessarily sell certain products which are Me Too in nature, but have been trying to do some, at least the large ones and some of the companies that we have also, and a lot of the participants on the street have participated in. They are doing some differentiated value add, which is making a lot of value for their customers and end user industries. So from that perspective, there is still a lot of steam. Believe it or not, some of these companies are also going to benefit from industries like electrification or solar. So EV or solar. So there are companies who are very well positioned. Most of these companies are run by technocrats, father-son duos, or family members who are very well invested in the business and want to drive growth. So I think it's a very interesting sector. We have identified companies. We are actually, our preference, if you ask within the sector, if I was to give my view, then it is on companies which actually are focused on very fast growing spaces. As I said, electrification, or whether it becomes solar or some other areas, or let's say greener and cleaner environment, which is the need of the hour. And most governments globally have basically committed to a net neutrality target, somewhere around 60 or 70, depending on how each government is positioned. There are companies in the chemical space who are just very well positioned to benefit from that change as well. So we are looking at those sectors first as an area of interest. That is where our positions are. Apart from that, we also like companies where what they are doing is not just a matter of a commodity or a product or just simple value add, but something that is just difficult to replicate by any competitor. So those are again businesses that we prefer, and we have a position on. What we have specifically avoided in the chemical space are companies whose businesses are very commodity-like in nature, where the demand and supply, they are neither a demand market leader nor a capacity market leader nor a supply market leader. So from that perspective, the raw material prices or the end product prices neither are in their control, and hence when the volatility takes place, there can be actually fall in material compression in their profitability. So this is what we call typically a commodity nature of chemical or even the metal space, and that's why we have avoided those companies. So just like I told about earlier about a question on metals, where we have avoided companies with commodity-like businesses in their business-like performances in their operations, we have similarly avoided chemical companies also who have commodity-like businesses in their operation.
Thanks, Adik. So I think we have reached the end of question. Once again, thank you everyone for joining in the call.
Thank you.
And thank you. See you soon. Bye. Take care.
Thank you. Stay safe.
Thank you.
Have a good weekend.
Thank you.
Bye-bye.
Bye.